Good evening, and thank you for joining us wherever you are in the world. Having said that, I think we're more this time of night is going to be UK and Europe. So thank you for joining. My name's Andrew Segal. If I could have the next slide, please. And I'm going to run through a little bit about the property market here in the UK, a little bit about us, and talk to you about a new launch that we've got, which is something it's different in terms of the payment profile. The returns are fantastic as well. So we'll run through that. But my name's Andrew Segal. As I say, I'm the managing partner here at Joseph Mews, and I look after sort of UK, Europe, Hong Kong, a little bit of overseas. We do have overseas offices as well. Got a Dubai office, and people are starting to come back there. We don't sell Dubai property, but it's to support people in that region that are investing back into the UK. And we've got a South African office as well. So we're a global company with global clients. If I could have the next slide, please. Thank you. I can see, yeah, a good number of attendees. Thanks for that. And I can see we've got quite a lot of new attendees. So just a bit of background because the property bit is easy, but it's the support and everything else that sort of supports that, which really makes a big difference and will really help you in your property journey. So we were founded in 2001 by Andy. He's also a property investor. Cut a long story short, as I say, big property investor. He was buying properties overseas, bought one in Spain, 1999. Still got that property today, and it's worked well for him. But the after sales and the support and the lettings was okay, but it wasn't really the one. And didn't really help him with the lettings and the furnishings and the mortgages. So he was left to sort of fend for himself. Whereas, as you'll see, we're here to make that experience seamless. There are a lot of moving parts, as you'll see, but we're here to support clients. And as I say, we've got clients and investors from all over the world. We've got a lot of clients who've never even been to the UK. They just know the UK is the most invested market in the world for overseas investor and arguably the most secure. So we're set up to support you, whether you're local, national, or international. Next slide, please, Han. A little bit again, we've delivered, we've sold and marketed, but more importantly, delivered. We're delivering units as we speak. So we're probably up to about 4,380 units delivered, which is most importantly. And we have a high number of repeat clients. 28% might not sound a lot because a lot of our clients are just buying maybe one or two properties. But where we're helping clients build portfolios, then they always come back to us and repeat purchase. As I say, the bulk of our investors, probably about 65%, just have maybe one or two, which is fine. We look after everyone the same, whether you're buying one or 100 apartments from us. And that's across now 43, about 44, 45 developments. And I'll come on to how we partner with those developers and why our stock is exclusive and why we get that exclusive stock. And we've delivered GDV, gross development value. We've delivered 632 million pounds worth of developments for our investor clients. Next slide, please, Han. I mentioned about the customer service, and this really, to me, is the most important bit. So there's quite a journey to go through. So if you see something you like, you'll reserve it. Then we get you to exchange. You typically exchange on 20%. What I've got to show you later is a lot less, but that's the normal off-plan model. And then this is where the customer care kicks in. We've got quite a big sales team, but we've got twice as many people in aftercare, handover, delivery. And we give you, if it's an off-plan development, we're giving you build updates throughout the build, and we're getting you ready for handover. So 6 months, 5 months before completion, we're getting you ready with things like, do you need a mortgage? Do you want us to furnish it? Is it short lets? Is it long lets? All that is done in-house by our own people. Even though we partner with different developers, we take care of all that customer care side of things. We get you to completion, and we're not just here for that one. We're here to get you through the completion and beyond. You've got a 10-year build warranty on the new builds. You get 2-year on the actual apartment. So it's us that's with you throughout the journey. And as I say, it's all in-house. Now, we have partners that set up limited companies, which I'll probably touch on in a minute. Um, we have lettings partners that we've worked with in many cases for decades and decades. So we kind of orchestrate, and you're a one-stop shop, and we do everything with you or for you. Now, if you're local to where our developments are, and you want to get involved and do it yourself, that's fine. 98% of our clients don't. I don't. I'm a landlord. I've got stuff in various places. I just want to get on with my day job. I don't want to get involved in the day-to-day management. So we make it a hands-free armchair investment. Next slide, Han. Hmm. So technically, we're a property promoter. What does that mean? It means we partner with the UK's leading developers. We turn down a lot. They come to us because of our sales reach, but more importantly, the customer care aspect that we do. So we give the developers a good reputation and vice versa. And we want to help with things like a portfolio review. Why do we do a portfolio review if you've only got one apartment? Because we might be able to get you better interest rates from the mortgage side of things. We want to do rental appraisals. I'm a soft landlord. I never really put my rents up, which is my fault. I've had stuff that I've had 4 years. I like it when people leave. For me, that's a natural way to put up your rents, and rents have gone up. I've had one property, and the rent went up £450 a month. Now, as I say, that's me, but I've got other friends and a lot of landlords that say, oh, if I can get £10 a week more, I'm going to kick them out or charge them more. And the market's strong. So you're in the driving seat, as you'll see, in terms of the supply and demand dynamics. Massive undersupply, huge demand. And again, if you are looking to build a portfolio, we can help tailor investment strategies, which normally involves, once you pay for your first one, you benefit from the capital appreciation, pull money out, equity release, and go again. So again, our relationship is with you as the investor, but just as importantly, it's with the developer as well. It's got to work for all parties. So we're here all the way through. Any hiccups on the way, if it's off plan and you've lost your job and you can't get a mortgage, we can help resell the unit before completion. All these kind of nice touches where a typical agent, for example, isn't really interested because we're wedded in with the developer. It's more of a joint venture relationship. Next slide, please, Han. Again, we like to make them, I say interactive. I realize I'm kind of talking at you guys, but there should be a Q&A box on the bottom there. Mine has changed, and it's under the more. It's where you see on the bottom of the screen. You've got more. If you click on more, there's a Q&A session. So please, any cues, any questions, anything to do with the market, which I'll touch on, mortgages, company structures, or any questions at all, let me know and we're happy to help. And there will be a way of us being able to contact you at the end should you want more follow-up information as well. Next slide, please, Han. Thank you. So quite a straightforward one, really. I guess most of you are probably, looking at UK property. Why choose UK property? Well, straightforward, really. Capital goes where the rules are clear. Demand is deep and time does the heavy lifting. As I mentioned with our customer care, there's nothing for you to do apart from fund the thing, and I'll come on to that and how that works. But you just get it, sit tight. It's let, it's managed, everything's done for you, and you benefit from the capital appreciation and of course the rental yield. So you get both more capital appreciation in certain areas and certain types of product, more rental yields in other areas, but we can help there as well. Next slide, please, Han. I just want to talk, everything's doom and gloom, isn't it? There's AI, there's wars, there's Trump, there was trust, there was COVID. I'm old. I've been in the market for many, 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 many and a bit decades. And it's about being in it for the long haul. Historically, prices, we'll look at the future as well and what the PLCs and what we're saying. But historically, probably prices have doubled on average every 12 years. You might say, who knows, there's a crash coming. I don't think there is. But look, I bought at the top of the market here, 2007, 2008, and you can see there was a dip there. And I bought property right at the top of the market because the best time to buy property, obviously, is 50 years ago or 10 years ago. The next best time to buy property is today because it's only, as you'll see, it's only going one way. So I bought at the top of the market, but guess what? I've still got those properties, however many years, 20 odd years later. They've doubled and a half in price. The tenants never left, and I always paid the mortgage. Unless something serious happens, we need food, we need water, you need a roof over your head. Whatever happens in this world, touch wood, people aren't going to say, "Oh, yeah, you know what? I don't know where to live now. I'm going to leave my going to leave my house." I've never known the market so good in terms of huge undersupply and massive demand. And as I say, I've still got those properties, and as long as you still pay your mortgage, happy days. The tenants are still there. So as it says there, UK property remains one of the most stable income generating asset classes globally. We all know, as I say, don't quite know exactly the demographic of the audience, but if we're all of a certain age, what have property prices done since day one? My dad bought his first property in 1960, £1,900. I bought my first apartment in late 80s, and that was £19,000. Have they ever gone back to those prices? Of course not. And when we look at the supply and demand in a minute, they're only going one way. We'll give you some stats to hang your hat on that as well. Next slide, please, Han. Thanks. The UK rental market is growing exponentially. We're coming into, or we're becoming what I call generation rent. So, average age of the first time buyer in the UK is 36 years old. It's crazy, right? Why is that? Well, two reasons. The main one, of course, is finance, is money. It's becoming, as we know, unaffordable. But it's also lifestyle choices. More and more people are living in rented accommodation. As I say, financial reasons, lifestyle reasons. We rent our music, we rent our videos, we rent our cars. It's, the world's changed. It's not all about home ownership, as I say, for those reasons. So the rental growth is crazy, and as you'll see, whatever Labour say, we're just not building enough new homes, enough new houses. Never have and never will. So that's why, as I say, this supply and demand dynamic is really important to understand. Next slide, please, Han. Again, Google it. ChatGPT, Google, whatever you use. Google rental demand in the UK. Average queue of tenants requesting to view a property in Britain has lengthened from 20 to 25 in 5 months. These are figures from Rightmove. So more and more people are, and I know, and if we've got, I can see we've got some existing clients on the call, on the webinar tonight. You'll see that for yourself. And if you look, Cathy Brook, the brick company, issued profit warnings. Concrete companies have been issuing profit warning. We're not building, from a planning rules and regulation point of view. Also, you've got to get it really right from a cost point of view. Land, labour, materials are going up and up and up. So it's very difficult. So there's less property on the market for all those reasons. So it's the perfect storm. Not good if you're a first-time buyer, not good if you're a tenant, but we're filling the demand and we're getting properties out there. So it is, it's good for the UK, it's good for us, and it's good for those tenants as well. We're putting more stock on the market. And next slide, please, Han. We'll come on to some figures and what the PLCs are saying. I think I've got a slide on that. But what's really interesting is we work with Blackstone and BlackRock. Top left there, BlackRock they've got 420, not million, billion of property assets worldwide. They're coming into the UK and doing what I'm doing, doing what you're doing, which is increasing their portfolio. Now, maybe you're buying one or two or 10. They're just buying or building whole blocks. They're not selling them. They're renting them out because they know what I've just said earlier on, huge supply and demand imbalance. So BlackRock, again, spend billions, millions on research. World's biggest investor, BlackRock, is on an asset buying spree in undervalued UK. So they wouldn't be buying if they thought there was a crash or if the market was going to change, or if we were on the high end from a pricing point of view. So all the experts, believe there's a lot more mileage to come. The King's buying land, where our UK HQ is Birmingham. The King's buying land in Birmingham to build on. Lloyds Bank are going into this BTR build to rent. So they build to rent and keep. So it's probably your money that Lloyds Bank are using if you bank with Lloyds. Legal and General, all these super professional institutions are building. And as I say, there's not enough with all these institutions. In Birmingham, for example, we should be building, well, the demands for 4,800 homes a year. Planning is only in place for 1,800, and half of those won't get through planning. So again, these companies might come in and put 500 apartments in, or 200 or 70. It's a drop in the ocean. It's not making any effect, which is why these companies are invested, because they know the rents are there and they're going to get the capital appreciation and the demand. So it's, again, as I mentioned, it's sort of perfect storm. Next slide, please, Han. So we've got a new development. I'll come back onto the Q&As and some of the reports. So we've got a brand new launch. It's in Wolverhampton city centre. I'm going to talk about Wolverhampton because we look at fundamentals and see how and why it's going to work. I mentioned property prices double in the UK on average every 10, 12 years. So let's just stick a pin in the map and buy anything. No, you can outperform the market. We outperform the market by doing a little bit of research. And I'll touch on some of that research in a minute. So you can outperform the market, because if you're looking at property prices from £150,000 upwards, you've got maybe a 25-year mortgage, 0.5% or 1% increase in rental yield, in capital appreciation makes a big difference with that amount of money over that period of time. And we've got a development. I'll come on to payment terms and how it works, because it is something very different. But normally you'd exchange on 20% of the purchase price. I'll give some examples of what that'll look. But here you exchange on a much lower amount, and there's interest-free monthly payments over the build. But I'll give some real life examples. But something very exciting that we're able to offer with this particular developer, Prosperity, because they are well funded. They're not borrowing any money to buy the land, to buy the development. They haven't got to borrow at 10, 12%, whatever they can get. So it just means they can be more flexible and offer these reduced payment terms. So it's the first time we've done it in 20, 30 years, and it's something really special. Next slide, please. So it's in Wolverhampton, smack bang in the Midlands in the UK, 15 miles from Birmingham, historical part of the area, massive history. And again, you've got, as we'll see, so many different types of jobs, which obviously helps on the letting side of things. In manufacturing, mining, lock making, you've got IT, tech, government, and I'll come on to the different departments because I think it's important to understand that when we look at the rental demand on both short lets and long lets. Next slide, please, Han. So sort of 5 pillars we look at in terms of, what do we want to look at from an investment point of view? We want to look at potential. Average property price in Wolverhampton is £214,000. Average rental yield is 6.5%. And as you can see there, we take this from JLL, Knight Frank, and Savills. So they're predicting 23% capital appreciation. It's an average of those 3 companies from now until the end 2029 or early 2030, and a 17% increase in rents. Again, we've got all the reports that we can share, and we do have detailed cash flow summaries. So we can show you how cash flow positive you're going to be once you look at things like stamp duty, service charges, rents. We can give you a figure to the nearest couple of pounds so you can see mortgage rates, so we can see how cash flow positive you're going to be month on month, year on year. So again, average private rents reached 900 per month. Rents increased 10% last year on year. I mentioned average property price is 214. Well, our price here is soft plan. We're starting at 154,000. So you're ahead of the market. And I'll come on to the payment term. So we've got all the fundamentals in place in terms of property price expectation, the economics, the forecast, the job creation, and regeneration, which I'll come on to because they're all really important factors when you're looking at property investment. Next slide, please, Han. Again, we talked about manufacturing. You've got Jaguar, Land Rover, you've got aerospace, you've got tarmac, massive amount of jobs, and governmental and healthcare jobs on your doorstep. Healthcare and public sector is the city's largest employer, supporting 22,550 jobs. The hospital alone, which is close by, has 10,000 staff there. So again, this development is only 71 units. It's not 1,000, it's not 2,000. So it's a very small development. And we'll have them rented before you take delivery, if that's what you want to do. So again, we look at the job creation. I've got as well a list of all the employers in the area. We do a Wolverhampton investment guide, and I've even got the council's 2030 vision guide to tell you what's happening in the city with employment and what massive regeneration they've got coming. And I'll touch upon that in a minute. But it's got it's got the jobs, it's got the job creation, it's got the healthcare, it's got the largest governmental departments in the UK outside of London. So again, plenty of employment, which is what we want, of course, for our tenants, to attract the tenants. And our market isn't the student market, although you'll see there's a big student area, big student catchment area. Ours is that young city centre professional, 26 to 36. That's the tenants we're attracting. Next slide, please. Thanks. Education's important. As I say, we don't really let out, it's more city centre professionals rather than the students. However, you can see a lot of the graduates, I think it's over half, are actually staying, living and working. So when they finish their courses, they're working in and around the area. They're on good wages, got a lot of tech jobs there. Wolverhampton is also one of 4 national test sites for the West Midlands. So this is like a pilot backed by the major employers to take the students when they graduated into local employment. Massive infrastructure. This levelling up as well is one of the largest areas where you've got these levelling up funds. So again, education is important, not for the student tenant demand, but for once they've graduated and they're in all these new, current and existing professional jobs, earning good money, paying good rent for your investment. Next slide, please, Han. Again, regeneration, there's 4.4 billion of regeneration. So there's massive infrastructure, new homes, new public realm spaces, new areas. They're tidying up the canals and the waterfront. Really is starting to look amazing. We want to get in nice and early. You don't want to be in when it's all gentrified. It's like my folks are originally from the East End of London. Well, no one lived in Brixton 20, 30 years ago. Now it's super gentrified and super expensive. And we're a little bit further along here because you've got the jobs and you've got all this regeneration, which is earmarked. And you've got, it's the first English city to sign this European Circular Cities Declaration. So basically, it's a long-term commitment to green and sustainable developments and public spaces, green spaces, etc. in the area. What I did, I think, which I think is quite good, and I'm sure you guys, we've got reports, you'll do your own research, but I put into Chat GPT, is Wolverhampton a good place to invest? And I'll read it. Wolverhampton is considered a strong value alternative to Birmingham, offering higher rental yields and a low entry price point, backed by significant regional regeneration. Wolverhampton consistently outperforms many UK cities in terms of rental yields. You can expect average gross yields of 7.4 to 7.5%. I'll come on to yields. We can smash that out the water with corporate lets. I'll come on to that in a minute. Particularly in the city centre and surrounding areas like postcode WV1. Ours is in postcode WV1. Private rents have seen strong annual growth, over 8% in 2025, outpacing the wider Midlands average. Low entry costs compared to nearby Birmingham. Birmingham comes out probably one of the top places, no, the top place to invest in the UK. Makes it more accessible for first-time investors, 150,000 compared to 300,000 in Birmingham. Major regeneration projects and game-changing projects that are underway. Canal Southside, City Centre master plan. You've got the connectivity, which I'll come on to, and I've got all this in the council's vision, which shows you what's happened, what's happening, and what's going to happen as well. So, perfect storm, really, what we should be looking at as buy-to-let investors. Next slide, please, Ham. And again, we talked about the regeneration. Yeah, it's underway. This 150 million transportation hub is there. It's up and running. Walk out of the back of the development. You've got a tram direct into Birmingham city centre and lots of other places in between and beyond. So direct link, tram and train to Birmingham, beyond, and of course HS2, the new rail, high-speed rail link from Birmingham to London. So it's there now. You know, the 150 million spent, and you can see if you walk around, you can see the improvements for yourself. So you've got the airport, you've got the rail, you've got Spaghetti Junction, M5, M6. Everything is on your doorstep. Perfect. Next slide. And again, this is just some of the sort of the local press cuttings. Plans to boost city and attract investors approved. I mentioned about this 4.4 billion pound spend to grow the city over the next 5 years. Again, talked about the average price point, and again, one of the most affordable cities in the West Midlands for buy-to-let investments. So it's again it's not just one of those things that we talked about, but all those things together make it perfect for investment. Next slide, please, Han. So this is our development, Penny Place. It's right in the heart of the city centre. Next slide, Han. It's the old Marks and Spencer's shop branch. So couldn't be any more centrally located. We've got prices from 154,950. I talked about the payment plan, and I'll give you some examples in a minute. But basically, if you see something you like, you put 5% of the purchase price down. Normally, everything we've ever done, those thousands of units we've delivered, you'd put 20% down. Here you're putting 5% down, and there's an interest-free payment plan over 24 months during the build process. So it means you're saving money because you'll need a smaller mortgage. I'll show you what those figures look like, and you're not paying interest on that. So again, we can do that because of prosperity. Andy, our chairman's known their chairman for 25 years. They're well funded, and because they haven't got big bank charges, they can do this and pass on that what I call those preferential investment terms to you, to the investor. And we're going to be ready Q1 2028. Next slide, Han. So if you say, I want that particular unit, we've only just launched 71 apartments. We're just really launching now, so we've only sold 15 or 20, so there's a good number of units to go for. Probably a month, 2 months, I think will be sold out, just looking at the rate of the sale. And now we're getting out to the wider audience and launching it overseas. But we've had, I think, interesting, a lot of local people have bought, which I think it is a good sign. So if you see something you like, it's a £5,000 reservation fee. That takes the unit off the market. Then, within about 2 or 3 weeks, you exchange on 5%. Now, you've already put down 5,000, so there's just another, depending on the price of the unit, there's about £3,000-ish to find. So your commitment initially is 5% of the purchase price and £1,500 for the legal fees. Boom, that's it. Then there's a payment plan spread over the build, spread over 24 months. You pay 25% of the purchase price. Give some examples of what that means in real money on the next slide. So you pay 25% of the purchase price every month, interest-free throughout the build. So over the build period, you've paid 30% of the purchase price. Yields, when we were talking 7%, 7.3, 7.4, whatever it was, yields, that's for short, sorry, that's for AST. So a normal long-term, laws change, but a normal sort of tenancy agreement, someone in long-term. Typically in our development, it's increasing all the time, but on average, people stay in our developments 2 years, 3 months. So that's increasing because of the limited supply. More and more people are staying in rented accommodation for a lot longer. And then we go up to 15%, and I'll explain why that is, which is quite exciting in terms of the rental yields. Next slide, Han. Okay, I'll come back to the rental yields in a minute. So an example, a one-bedroom apartment, 538 square foot. That means anything. Average apartment, one-bed apartment in the UK today is probably 450 square foot. So they're good sizes. Price is 164,950. So you reserve on £5,000. That takes the unit off the market. It's yours, it's reserved. Then you make up the difference to 5% within 28 days. So it's a further 3,248 to find, plus 1,500 in legal fees. So that's your initial commitment. And then you're paying 41,000, just over 41,000, over 24 months. That equates to £1,718 per calendar month. So easy payment terms. So you can see May 26th, £1,700, June 26th, and so on. And then at the end of the term, you have paid 30% of the price, and then you get a mortgage, which we can help you with for the balance, which is 70%. It can be cash, 70%, can be all mortgage, or cash, or a mix, depending on your financial situation. Part of our service, we've got brokers that specialize, if you're a UK client, brokers for overseas clients as well. So again, nice payment terms, helps you plan, and you're not having to find the 20%, which is normal, up front. So you can use that money because you know you've got £718, £1,718 to find over a period. So you can make your money work for you and your drip feed in that balance, if that makes sense. Next slide, please, Han. This for me is probably the most exciting element. So we partner with my property host, and again, guys, we can set up calls in if you want to speak to our account manager there. My property hosts are a specialist short-term corporate letting partner. They have other developments, one other development in Wolverhampton. They have, it's short-term lets. So it's a little bit like your Airbnb, your holiday lets. Obviously, not too much holiday making, although there is quite a bit in Wolverhampton. They have other apartments in Wolverhampton on this short-term let model, but they're mainly to the health service, to the tech companies, Tarmac, Marston's, all these corporates. They take them at short-term let rates, which is from £75 a night. However, they'll take a 12 to 15-month contract. So you have 100% occupancy because it's a 12-month contract. Normally with short lets, it'll ebb and it'll flow. People come and go. And with my property host, it's the average, if it's not a corporate contract like this, it's not just weekends and things. The average rental stay is about 2 weeks. So again, you're getting a lot more money over a shorter period of time. So we've got a proven partner already operating with a number of units, and they'll take 20 units from us. So we've sold, out of the 10 we've sold, funnily, or whatever the number we sold so far, everyone's gone for this option. So I've got 10 units left where we can guarantee these corporate lets. So it's a much higher return. It actually works out at about a 15, near a 16% gross yield. We've got detailed cash flow summaries. To put that into real money, and I'll summarize it. got a lady, Wolverhampton lady, that bought from us today, reserved yesterday rather. After all the fees, all the charges, your stamp duty, managing the short-term lets, service charge on a £165,000 apartment. She was £830 a month cash flow positive, net, 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 net. So that's £830 a month profit on £165,000 apartment. And that's going on today's interest rates. You're not going to need a mortgage or pay your stamp duty till the very end. We, the experts, do expect, who knows what's going to happen in the world, but we do expect mortgage rates to come down. But you've paid off 30% of your mortgage anyway. And with these high rental returns, it's going to more than wash its face. So it's a really good return. If you look, bearing in mind you're mortgaging 70%, you've put 30% of your own money in. Yes, stamp duty, legal fees, a few bits and bobs. Return on capital employed, because you're leveraging, you're mortgaging, you're borrowing, you're getting a 16% return. So let's say you've put in, to start with, stamp duty, all your bits and bobs is about 60,000 pounds. You're getting that £838. So that's an equivalent of sticking it in the bank and getting a 16% return on that money invested, return on capital employed. Myself or my team, more than happy to go through the maths with you in more detail. And we do have, just throwing figures at you, it's just some figures I did yesterday, but we have detailed cash flow summaries and can demonstrate and show you those figures. And they are being achieved now in the area with our provider, with another development, and they're desperate for another 20 units. Probably be more, but we just said let's limit it to 20 just to make sure that we've got that. We can guarantee that 100% occupancy and zero void period. So hopefully that makes sense. I think I've laboured that enough. Again, we can always have a conversation with myself or one of the team members to run through the maths in more detail. Next slide, Han. Again, location couldn't be better. Right in the middle of the city centre, got the Wolves City Ground. The main line train station is a short walk away. The tram station is slightly closer. Shopping centres, bars, restaurants, gyms, everything is on your door. Everything's on your doorstep. We took a view not to put things like swimming pools in, gyms and climbing walls in, because it affects the service charge. Service charge is something you'll pay to maintain the building insurance. There is like a lounge and a reception area. And there's a nice internal gardens and courtyard area, even though you're in the heart of the city. It's very tranquil. I think I've got a picture of that. So the service charge is good. That's all factored into when I talked about those cash flow summaries and those net returns. So again, you're seeing a true net figure. And the service charge, 10 years time, it needs new carpet in the communal areas. That's all covered in the service charge, which is just about £1,000, depending on the size of the apartment, per year. So again, very affordable. If you start putting things like concierge in, well, a two-man concierge is 180 grand a year to run. Don't want to do that because you're going to pay that in the service charge, and you don't need it because everything is on your doorstep. There'll be a post room and a lounge, but we keep it stripped back just so it's as more profitable for you as a landlord. Next slide, please, Han. So these are some of the artist's impressions. We've got videos of show apartment that the developer's done before, and it's going to be the same quality. And yeah, they come with all the white goods, everything you need to get you up and running. We, as I say, we work with you. Furnishing packs. If you're going for the corporate lets, you're going to have to spend a bit more on furniture because they want a TV and a coffee machine. However, we factor all that into those net returns just to make it profitable. And spend it, you need to spend, as I say, Wi-Fi, bits and bobs. We've allowed for all that in the returns I mentioned. And what's quite nice with the corporate lets, the one beds go from 165 to maybe 175, 180. It's the same return whether you spent 165 or 170 or 180. So we really, it's a bit like when you go to a hotel. You don't know what room you're going to get. You don't know what you're getting. You don't know what floor you're on. So we want to get the best but the cheapest. We don't need a third floor one, a lower floor one, a less expensive one. Will do the trick with the corporate short-term lets. Next slide, Han. So that shows you a few bits and bobs. What does it take to be a Joseph Mews client? Joseph Mews client. We work with individuals who, have immediate access to that £10,000, that monthly payment. I've got studios which are less money, and the studios work for the short-term lets as well. They go from 154. So £1,700 ish per calendar month. We can obviously tell you what that's going to be depending on the unit type. Open to expert-led investment guidance. All I've done is property. I'm very old. I've done it since I was 19, and I'm a little bit older than that now. And my team, the team we've got here, are super experienced investors themselves. You're actively looking to invest, to grow your portfolio, and have a long-term growth focused mind and clear investment goals and strategy. As I say, you fund it, we'll do everything else. We'll give you the returns and we'll manage everything. So it's fun, stress-free, and profitable. Because at the end of the day, it's just a mathematic exercise. And we like to get to know you. Are you looking for capital appreciation? Are you looking for rental yields? What are your fears? Procrastination's the killer. Most people, I can see we've got a good number on today, but most people are frightened, don't do anything, think the world's going to end. It may do, but again, just Google it, look at historical property prices, look at the regeneration that's going on here. And as I say, if you want to, you can speak to the company I mentioned that we're working with on the corporate let, just to give you full peace of mind and make sure that you're 100% happy with any investment you make. Next slide, Han. Okay, so thanks for taking time out. I'll come on to the Q&A session in a minute. And a little box you can click if you want some follow-up information or for us to contact you. Anyone who reserves before the end of the month, before the end of April, we get £1,000 towards legal fees or furniture packs. So we can help there. We can track you, so we'll know you've been on the webinar, and we know that you've reserved by the end of April, by the 30th of April. So we can help there. Next slide, Han. And you'll need to move sort of quickly anyway, because honestly, there's only 71 apartments. We've sold 10, 12, 13. And we haven't really gone out to agents and our sort of distribution partners. So they'll be gone probably by the end of the month. And it's the less expensive ones that are going. But as I say, even the most expensive two-beddy is just a little over 200,000. But again, we can share all that with you. So next steps, click one of the little circles there, book a free property consultation. Hopefully you can see we're pretty relaxed. So book a consultation, no obligation. Let's talk to you about it. We can go through the cash flow in more detail. If you want to talk mortgages, you can do. You're not going to need a mortgage for till it's ready. However, if you want to just check out where you are from a mortgage point of view and you know that you're qualified for a mortgage, generally you will. I've got people that my mortgage broker says, or our mortgage broker says, if you're 100 years old, we can get you a mortgage because it's based on that rental income. So again, if you want to talk anything on mortgages with your particular situation, we've got people who aren't working, 70 years old. We've got a Malaysian lady who's invested, but they just look at the income. But again, you can have a no obligation call with the broker. Also, as well, something we touch on in other webinars is limited company structuring. So it's very easy to set up a limited company, which can make it much, much, much more tax efficient. And depending on your situation, it might be good to put it in your own name, a partner's name, or joint names. 70% of the time we're seeing people are putting in a limited company structure, particularly if you're looking at wealth preservation and you don't want to pay capital gains. or inheritance tax if if you're looking to pass it on through the generation. So again, separate subject, different webinar, but tick the mortgage consultation box if you want any kind of technical support, whether it's limited company structuring, finding out about the rentals, and we can help there. And tick the box for consultation. If you're just exploring, that's fine. Appreciate, people might have been in a position to move now. If you are, I don't think we'll ever have anything like this again at this price with these payment terms. So just click that one. Have we got the next slide, Han? Okay, forget the Q&As. Let's see what we've got coming on the Q&As. Hi, Lauren. Thanks for this. I missed the beginning of the call. Have you already discussed why the deposits are so low and the average rental yields? Yes. Deposits are low because the developer is super well funded. So say our chairman's been their chairman for 25 years, so they haven't got massive interest charges and they can afford to do it. And it's a model that they've used before. It's the first time we've used this model and it works well. And I think I think you probably come on board when we talked about the average rental yields. For a normal long-term tenant, if you like, we're looking at 7%, 7.1, 7.2. As I mentioned, they went up 8% last year, the rent. So by the time we deliver, we expect them to be higher again. Nothing else is being built in and around the area. So a lot of the regeneration is on the outskirts. So there's no competition. And again, as you probably saw with those short-term lets, we're up to 15, 16% as well. But again, we can go through those figures. So click on one of the boxes and we're happy to help. Anonymous is saying, what about the furniture? Is it a furnished market? If you're going for the long-term lets, it tends to be a little bit more of a furnished market. What we're seeing now is we get non-furnished, furnished, partially furnished. So you just put in things like blinds and a few little bits and bobs because we're seeing more and more people, as I mentioned earlier, staying in rented accommodation. Well, forever these days, we're becoming more like a European model where it's 80% renting, 20% buying. We were the other way around, but that's changing dramatically. So again, we do furniture packs, everything you can think of we do. So nearer completion, we'll advise you is the best route to go down. If it's the short-term let serviced accommodation model, then yes, you will need furniture. Another anonymous question. Average price of the furniture packs. The little interim sort of small packs, about £1,500. We'll spec that out. Full, you wouldn't need to spend any more than about £4,500 on a one bed for the short term let with the TV and the coffee machine, etc., etc. So yeah, all pretty straightforward. Someone's saying, can you help with limited company structuring? Yes, Bob, we can help and advise there. We work with specialist accountants. We are looking to bring that in-house as well to offer that through our finance department as well. But either way, we can help. Yeah, now, what about someone saying here, John, what about the costs of managing in the short term? Yes, there's like a booking platform for any fees. There's the management. There's the meet and the greet. There's a lot more costs than the long-term lets. But as I mentioned earlier, the profits are higher, particularly if you've got one of these corporate lets where you've got the £75 plus a night, 100% occupancy. So that's when I mentioned after all the fees and charges, the lady that bought that unit, reserved that unit for 165,000, after everything, all the fees and charges, she was cash flow positive, 850, £860 per calendar month. Can you tell me about the lease and the ground rent? Yeah, I can. Lease, brand new lease, 250 years long. It's being scrapped anyway, and they're kind of like virtual freeholds these days. Why? Because there's zero ground rent. You're not paying You're not paying any ground rent. So that gives you sort of freedom and flexibility there as well. Unless anyone's got any other questions, I think that's about it. I do have, which we'll run, I think will be the next slide. I've got a video, which is our chairman probably telling you everything I've said in about 3 or 4 minutes. So it's just a nice summary from Andy, from our chairman, talking about the regeneration and what's happening in the area. Thanks, Lauren. That's very helpful. Thank you very much. Yeah, thanks for all your for letting me know you've enjoyed that. As I say, tick on the box, and we'll follow it up anyway, just to see if we can help and go into anything in more detail. And I think the next slide should be the video. Yeah, so hopefully that runs okay. Thank you, Hannah, for organising the slides for me. I'm not that technical, so that went smoothly. And the video should work now. And hopefully, depending on the numbers that want to call, I'll try and get round to you, or be one of our experienced team members that can go through everything with you. Thank you very much. Thanks for joining us this evening. Much appreciated.
Property Group, and today I'm excited to announce the launch of our latest development, Penny Place, which is located in the heart of Wolverhampton city centre. At Penny Place, Joseph Mews are partnering with the local developer Prosperity in Birmingham, and we've had a long relationship since the year 2000 with this developer, and we're really excited to enter this new chapter where we're working together. Penny Place is a conversion of a historic building, one of the first Marks and Spencers on the high street in the UK. We have 6 studios, 61 beds and just 5 2-beds. The amenity space are an outside courtyard and garden and a large reception area. It's located right on the high street, right in the heart of Wolverhampton, in walking distance to 25,000 jobs, to the university and to all the bars and restaurants and shops within the area. What's really exciting about this new development is the price point. It's just over £300 a square foot, which means the entry level for investors is just £155,000. And I haven't personally seen this for 5 or 6 years. A price as low as this, allowing investors to get onto the ladder at such a low price point. There are only 1,500 apartments currently in Wolverhampton city centre, and the plan is to increase this to 8,000. So we're at the base of a steep curve of growth, and Penny Place is right at the beginning of that growth spurt. So what's creating the demand today in the city centre is this Regeneration project, a £10 billion investment fund to transform the city into a pedestrian public realm with new transport links and places to live, work and play, rather than the old typical style of high street with retail and banks. During the past 10 years, we've seen Birmingham go through the Big City Plan, which was a £16 billion regeneration project, which has virtually doubled the price of apartments within the city, with all the growth that's entailed. And now the same is happening for its sister city, Wolverhampton, on a smaller scale. We're going from 1,500 apartments to 8,000. But the demand through this new job creation is driving the whole project forward. In the city of Wolverhampton, there are 25,000 public sector jobs. These are split up into 11,000 at the hospital, 7,000 at the council building, and 2,000 at the University of Wolverhampton, and another 2,000 at the I-54 Business Park and the I-9 Technology Hub. To complement the growth within the city, the transport links are being improved. Already the train station has undergone a regeneration programme, and now the tram will go all the way to Birmingham and back, making connectivity much easier between the two cities. And one of the best assets of the city centre is the university. With 25,000 students, it has a remarkable 77% retention rate. And what that means is each year, when 8,000 students graduate and leave university, almost 6,000 stay to work and live in the city centre. And this is driving demand for new apartments and new jobs. So let's have a look at the profile of the tenants who will live at Penny Place. There'll be young professionals, there'll be ex-graduates, there'll be people with budgets for £1,000 to £1,500 a month, and they'll want to live and work in the city centre. They want to cut out the commute these days and have a place to live where they can just walk to work and also walk to the coffee shop, to the gym, and to the bars and the restaurants. So what's attractive about Penny Place is for those seasoned investors who are building a portfolio, it'll be really easy to add one or two of these apartments to the portfolio. And of course, if you're a first-time investor, having such a low entry price point will make it much easier for you to start your portfolio off and get on the ladder. With such a robust regeneration programme for the city centre of Wolverhampton, we're projecting 7% rental yields at Penny Place and also 6% capital growth per year for the next 10 years. So yes, I'm really excited to bring Penny Place to you today, because we haven't seen this story since the regeneration of Birmingham, the big city plan from 2015. It's been just over 10 years since that started. It's been so successful in Birmingham, and I'm really excited to bring Penny Place to you today, because it's all starting again right next door to Birmingham. It's happening again in Wolverhampton, and it's a great opportunity for investors right in the heart of Wolverhampton city centre.